Hello everyone, welcome back to the channel. This is Fair Value Finder, and today we are taking a look at another requested stock. And this one is Old Dominion Freight Line, ticker ODFL. It's currently trading north of 180, coming up with a fair value around 135. This kind of cash flows 87. So it's definitely looking like it's pretty overvalued, but we'll get right into the numbers and see if it's got some future growth potential that is leading to it being overvalued and what a decent price to get in may be. Earnings yield 3.13%. We'd really want to see them come in with $9.11 in earnings per share. And this last year they came in at $5.71. This year they're expected to come in at $5.95. Next year, $7.02, according to analysts. So it looks like that would probably be somewhere in the realm to 4, maybe 5 years out. So that's definitely trading at a huge premium to its earnings. Cash flow yield looks good, 15.9. Traditionally, 14.25. Great numbers there. We like to see double digits. Definitely don't have a problem with that one. Dividend yield, pretty low, 0.6%. Average 0.4. Payout ratio, super low, 14%. So they've got quite a bit of room to grow this thing and get it up to a reasonable level. Returns here, return on equity, return on investment, and return on assets are all north of 20. Incredible numbers there. Debt to equity, 0.29. Super healthy balance sheet. Margins look pretty good, 35.44. On average, 35.14. We like to see north of 30 there. And net, 21.19, usually 21. That could go as low as 10, and it would still be okay. So a lot of things here look very good. All of this, super strong. This is really good. Clearly, they're not huge on paying out a dividend, and they've got super strong cash flows that they could if they wanted to, but they seem to be investing it back into the business. It's just trading at a huge premium to their earnings because of this solid business that is underneath. So now we can develop a thesis here. I've already gone through and put in some numbers that I think would be reasonable, where we've seen them come in all over the place in the last few years for revenue growth. Compound annual growth rate in the last 3 years was 3.83. In the last 2, it was negative 2%. Analysts are projecting 4.18 this next year and 6.87 the following. So if we go with something kind of in between what analysts are projecting, this would be what we're looking for them to come in on average for the next 3 to 5 years. Would be this 5.5%. Share count, they're buying back shares. That's something that we love to see. That's a great 2% boost to most of the fundamentals here and helps boost the price of the stock as well. Definitely buying back a lot more than we see other companies, and looks to be slowing down in the last 2 years. Could just be that the price is getting higher. I mean, I put down 2% here. It might be lower. They did go as high as 220, almost 228, and they've pulled back $50 from there. So they've had a pretty good pullback from their highs. Cash flow growth, another one that's kind of all over the place. 12% in the last 3, essentially flat in the last 2. If it comes in close to the revenue, they would hold their cash flow yield. It'd be great to see them hold at this 15.5. There is some room that they could go back down to their average, though. So we'll stick with this 5 for now and change it to see the impact later on. Assets, 8, 4.5, 6 is in between those. 6.4, 3.2, 4 is in between those. Trying to come up with something kind of reasonable. Clearly, they've slowed down more recently on everything related to the balance sheet. But as long as the assets are outpacing the liabilities, things should be good in the long term. Dividend, they've had some huge dividend growth. Of course, we'd expect that to slow down because you're now growing a larger starting base for your dividend, and this 20% growth would take them to $2.60 a year in 5 years, which is a 1.4% yield on cost if you bought at today's price. And then margin-wise, I wouldn't expect too much movement there. They seem to be pretty stable at that. So we'll just hold that where it stands currently. So if you buy at today's price, if this thesis is what you get out of the company in the next 3 years, then you're overpaying. You're overpaying by about 10% from what the potential value is in 3 years for this stock. And then in 5 years, you have a year and a half worth of growth compared to SPY. I mean, in these same time periods, SPY is doing 26 and 47%. You're only doing 12. And this is the growth in the fair value of the stock. Clearly some great growth, 10% average returns, definitely gets it a spot on the watch list. But what would be a reasonable price to pay for it is the question. It's been as low as 165. Is that even low enough? Personally, I don't think so. You're basically paying the 3-year value for the stock and sacrificing a lot of growth in the 5-year because you're overpaying to start. Now, I know this is probably another one of those that just always trades at a premium, and it just depends on the investor. Personally, I would be willing to pay a bit of a premium for this one because of the solid fundamentals that we see here, but I'd really have to get a deeper understanding of the company to know. We can take a quick look at all of the valuations graphed out and see how things are moving here. And everything is just up and to the left, which is what we like to see. The balance sheet is always down here towards the bottom. Cash flows just above it. There's decent spacing between everything. The fair value almost smack dab in between everything, especially in 2022, 2023. The dividend, if they continue at this pace, will be the main value driver here. And then the actual share price. It looks like that share price has outpaced everything since 2022, aside from the dividend, which over time will be adjusted. It's just we're looking for their typical yield, the typical yield that the market is willing to pay for this stock. So now we can come back to this and see if there's a more bullish scenario. So for revenue, this 5.5, we can move up. Analysts are expecting in 2 years, 6.9. So if they can hold out that 6.9, we can see if it adjusts the average return from 10.38 goes to 11.14. And now you're not necessarily paying out the 3-year price. You're getting a bit of a return. Share count, I really feel like 2 is fair. I mean, we can go with the 2.36, but I think that this is a little too bullish here. So 2.4 gave them almost 0.5% again on their average returns. Cash flows, keep them in line with the revenues. If they can hold the current cash flow yield, that would be incredible. Gave them another 0.2% there, 1% on the 3-year. Assets, 8% is on the higher end. Liabilities, we'd want to go towards the lower end on this one, 3.2. Dividend, 38. Margin, 1%. Now this would be incredibly bullish, and it would be completely reasonable to pay today's price because you'll make up for it within 5 years. Getting 70% returns compared to the market's 47. Average annual return of 18.23. It becomes 18.81 once you factor in the dividend. And to be honest, that's factoring today's dividend. If I thought this were the case, I think it would be a no-brainer buy. But I do think that it's a little too bullish. And we'd really need to look at some of these numbers because the 2-year compound annual growth rate here on most things is a little concerning to me, like the revenue, EPS. The slowdown in the share counts, not completely unreasonable, but everything just slowed way down. Cash flow growth went to almost nothing. So we can take a quick look and see what the heck happened in here. Almost no growth across all the financials in 2023. But a lot changed with the balance sheet here. We're seeing double-digit changes across everything. They're stacking up a lot of cash. If the earnings far outpaces everything, we can adjust this and give it a heavier weighting if that's what the market seems to prefer. Like, the market's not typically valuing a stock for its balance sheet. Earnings are the main driver. So if we shift some of the weighting from the balance sheet to earnings, we can take a look and see, well, now it's an even better deal. You're almost in line with the markets on the 3-year. I mean, your average returns cut down a little bit because now we're talking about a larger starting fair value. This has jumped over $10. This has jumped at least 10%, shifting those weightings. But I personally still think 165 is a little too pricey. This would be a stock where I'd sell puts and I'd do trades, and I would try to just invest with other people's money rather than my own, because it's just too big of a premium for a value investor. Now, if you love a stock with strong cash flows and a strong balance sheet, this is definitely a stock for you. It all depends on someone's investing style. It definitely looks like it's a dividend growth stock as well. Might not have a great starting yield, but some incredible growth coming through. So I want to thank you guys for watching this one. Please like and enjoy the video, comment what other stocks we should take a look at, and subscribe so you can stay up to date with everything. And I'll catch you next time.